Hello, welcome to another edition of Nucleus Investment Insights. Apologies running a little bit late today. A new and a different sort of setup today. So yes, as things happen, you test these out and it all works fine. And then when the bright lights come on, there's invariably issues from setups before. Anyway, I won't sort of dwell too much on that. I'll just sort of jump straight into this, straight into the thoughts about Oracle. So there was a Oracle shot up 40% overnight. I think it's a little bit of a talk about Oracle, but it's actually more of a talk about the broader market in its and what's happening in AI, because it's sort of a bit of a Rorschach test about how you see the market and what's there. And it's also really, I think it's a really interesting take on AI and where it sits in terms of what you think about a bit player, or maybe not even a bit player, because they're almost $1 billion in market cap. Pretty hard to describe a company, almost $1 billion in market cap as a bit player. But they're sort of like the fourth biggest of the hyperscalers, and someone who's going through this sort of massive change. And so so well worth having a bit of a discussion about what's going on, what it means for the broader market, and how we're thinking about Oracle and what it means within it. So just a note as well, anything you hear today is not personal advice. It's all general in nature, and if you do want to get personal advice, then certainly have a look at our website and log on to have a chat. But yeah, it's nothing takes into your own financial situation or needs. But with that sort of behind us, let's talk about. Sorry, still trying to get my setup right. Let's talk about what we're seeing within Oracle, and so their announcement basically overnight was that profits are up a little bit, but future revenue looks really, really big, and they're signing they've signed a whole bunch of sort of massive deals with people like OpenAI, and two or three others for I think the OpenAI one is for hundreds of billions of dollars over the next few years. And it's what we're thinking about. I sort of think about these guys a little bit the way you think about NVIDIA, insofar as if you want to buy NVIDIA today, you're not buying them because you think they manufacture really good video cards for gamers, which is sort of where they came from. Video cards for PCs, and Oracle, is very much built on the back of. Sorry. Let me keep going with the NVIDIA analogy, because it stretches a little bit further. So NVIDIA, in a way, like the way we sort of view it, was they got lucky in a big sense, in that they were making these chips, the graphics processor units. They were one of the best. They're certainly not lucky in terms of being the best in that space, but they got lucky insofar as the calculations that it was doing happened to be the calculations that AI really needed to be done really well, and they sort of went through a little bit of a microcosm of it a few years earlier, where it was actually the same calculations that was good for mining Ethereum, and then that faded off, and then the next one came up again in terms of its AI. And so, but what NVIDIA was very good at doing was turning that into a much bigger business, and turning that into something where they're looking effectively to be the operating system, as well as the license holder for some of the best chips still, but the operating system for data centers, and a whole new way of doing data centers, in terms of it used to just be racks of computers that would talk to each other across Ethernet cables, and each sort of computer was sort of relatively separate. Whereas what NVIDIA is building is these vast sort of teams of computers that are, and better integration of the chips and other things like that. Anyway, so what I guess I'm trying to get to with that is, if you're buying NVIDIA, you're not buying it because you think it makes great graphics computers for your gaming system. Like while that's where they came from, it's such a small part of the revenue now, and all of sort of this future revenue is what you're really buying it for. So now Oracle is in a similar place. So one of the biggest things they do is this is the Oracle. One of the biggest things they used to do was the Oracle database, and they'd sell that database to various companies, and they tend to be bigger companies. I think there's certainly there's a lot of different databases out there, and a lot of them are free and open source, and a lot of the open source ones are very, very good and are used very broadly. But Oracle has got some deep ties in terms of companies, and once you start using a particular database, it's very hard to change. And so you've sort of gone, there's Oracle, there's Microsoft databases, Microsoft SQL, and then there's a whole bunch of sort of open source type ones that you can sort of get into. And so Oracle's been very good at was very good at capturing that market, and they rode through the tech boom 25 years ago, and prices shot up, and then they fell 80%, and it's been a services company from there on. What the really interesting thing that's happening now is that their data centers is where all this is happening. So they're the sort of the fourth biggest in terms of the hyperscalers. So you've got AWS, which is Amazon, Microsoft, and Google that all have these data centers out there and cloud computing, and you can basically hire the computing from these guys in the cloud. And Oracle's always had a bit of that, and a lot of sort of software as a service. So the idea is they're running their databases for people and doing things like that. So they do have a big knowledgeable workforce in this space. So good at databases and processing data, good at managing machines and outsourced software and stuff like that. And so where they're really sitting now is, do they have this massive competitive advantage? Well, not really. They've got the all the chips and everything they're just buying from NVIDIA, and a lot of the data centers spaces themselves they don't actually own. They're going and getting other people to do the sort of data center setup, and they're sort of doing a lot of the management in between. And so, is there something you point at and you go, yeah, look, these guys are absolutely one of the best in the field, and so therefore, and they've got this huge margin and huge margin of safety and economic moat, and they're going to be the guys going to succeed. And you can sort of go, well, no, not really. They're sort of the fourth out of it. They're still, all these other guys are in a similar place, but Microsoft has its sort of captured customers, which sort of funnel the next batch through. Google and AWS have been competing in this space for a while. There's a bunch of other people who you probably haven't heard about, but a lot of them are listed that sort of run this very sort of bare bones type data center things, and so Oracle's sort of stepped into this space, and it's basically, in a way, it's sort of this lucky part similar to NVIDIA in terms of, look, it's got a knowledgeable workforce. That already knows about moving this data around and setting servers up and managing that whole system, just as there's this massive explosion of demand for this stuff. And this is where, that its revenues are sort of, it's talking about, revenues up 3 or 4 times over the next year or two, and up sort of 10 times in that data division. And so it's very similar in terms of NVIDIA going, look, it's just this one division is going to grow to dwarf all this other stuff, and if it's going to grow the way that they were talking about today, and you do get that sort of 10x increase in revenue, then you're basically a hyperscaler with a small database division, sort of, the original stuff that's sort of still sitting there. And so that's the way we're thinking about about Oracle in terms of how you're looking at it. Is you really do need to look at it as, can it be this fourth player? And then what does it mean to be that fourth player? Because there's a whole bunch of other things that sort of flow through from that in terms of the investment outlook and how what it means for investors and how it's going to go. But let me jump quickly to a quick sales message, and then I'll come back and talk a little bit more about that.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yeah, so the analogy, just to sort of jump around between between different boom analogies, is the analogy I wanted to talk about was the it was now sort of a mining boom type analogy. And again, give me a couple of minutes just to set the scene first, because it'll lead somewhere that is actually interesting. Trust me on this one. So when you look at a mining company and mining booms in particular, you have this sort of idea that there's this base price and this cost that you can the cost of production that you get. And so let's say we're talking about iron ore, and we're saying, okay, long-term prices for it, $50, $60, and you look at the producers and you go, okay, well, let's say it's some of these top tier BHPs or Fortescues or Rios or actually Fortescue probably sits a little bit further down, but if you look at these ones and you're like, okay, so BHP or Rio, and they might be producing, say, at $40 to $50, and then they're getting to sell at $50 to $60. There's sort of this margin in there in the long term. They make these profits and off they go. And so let's say you've got a high quality mine. It's at $40 as a cost, and the price is 60. So it's like, okay, for every ton, I'm making $20. Now the price goes to $100. So I go, okay, so I'm making $20 on that. Now I'm making $60 on 3 times my revenues. Yeah, that's great. It's a nice pickup, and you're doing really well out of that. Okay, now I've got this marginal mine. Someone else has got a marginal mine, and that's sort of sitting out there, and say it's got a cost of $100 of production. So it's you got to truck the stuff out of there, and it's a little bit harder, and it's not as big in scale, and all that type of stuff like that. So your costs are much higher. So at $100, you break even on this whole thing. The thing's running, but you're not making any money out of it. Whereas BHP or Rio is making lots of money. Now, as the mining boom gets bigger, though, it goes, okay, now we go to $110. So BHP was making $60 per ton. Now they're making $70 because the price has gone from 100 to 110. This other person, though, has gone from making $0 to making $10 a ton. So they're much happier. And then as you go from $110 to $120, yeah, BHP goes from making $70 to making $80. Yes, it's an increase, but it's a relatively small percentage increase in terms of their profits. But the other guy doubles their profit because they've only, they were making $10 a ton, now they're making $20 a ton. So in a boom, the people that really benefit in a mining boom, the companies that have the most leverage in terms of the price are the worst quality ones. So yeah, if the price falls back below $100, now this one's loss making, and it's going to be the first one to go broke when the boom finishes and all that type of stuff like that. But the bigger the boom is, the more that company's going to go up versus BHP. So the price goes to $150. BHP might go up 30, 40% or 50%, but this other one might triple or quadruple because it's just its profits are just gone from $10 a ton to $50 a ton. It's sort of going through the roof. So okay, so a relatively long analogy. That's sort of in the way how I'm thinking about Oracle and why it's such a Rorschach test in terms of what you think about this AI boom and the CapEx in particular around it, and whether it's sustainable. Because these are the guys that are sort of not that top tier in terms of the in terms of running these data centers and having all the infrastructure set up and the whole process and all that type of stuff. These guys are sort of the fourth there, but there's a massive boom going on, and everyone really, really wants this commodity, and so people are prepared to pay up for it. And it's like, well, I can't get a space with Microsoft, or I can't get as much as I want with Microsoft because I want all this processing power, but I'm only $100 million company, and they've got $1 billion companies who want processing power, or $100 billion companies who want processing power, and they're in the queue in front of me, and so I just can't get what I want from these other guys, or I can't get it as fast as what I want, and so I need to go and overpay for it somewhere, and Microsoft and Google and Amazon are expanding as fast as they can, but they can't expand fast enough for me. So now I've got to go to the 4th tier player or a 5th tier player to try and get that up and running. So if you look at it from that perspective and you go, okay, if this is just a really short-term CapEx boom, then Oracle is absolutely not the type of company you want to be investing in. Like that sort of, the person who's sitting on the edge of it and is only getting all this massive demand because people just can't get the space they want at other places. But if this is a more sustained demand, if you think this is a 5-10 year story, then Oracle's the type of company that's going to have more leverage to the whole boom than others. And I think that's really what we've seen so far, is that the price is up that 80% this year or something like that, up 40% overnight. But it's that it's that thought now, is that, look, is this the type of company? Is this? How do you think about the boom? Yeah. Do you think this AI capex boom is going to be short lived, or do you think it's going to be a long lived one? Because if it's long lived, then it's got longer to play out. If it's short lived, then this is the type of company you want when the whole thing comes, when the wheels fall off it. This is the type of company you want to be short, not long. Okay, so there's that part of it. And then it also sort of flows in from from some of the quality aspects as well, when you start looking from this aspect as well, because even though Microsoft, AWS, Google are spending these extraordinary amounts in terms of capex and just doubling and tripling the amount of spending they're doing and trying to get data centers everywhere they can, they're all still cash flow positive. Like, they're all they're spending so much money, but they're making so much money. So it's sort of a bit, it's not as much of an issue, or you're certainly less concerned at this point in the cycle. Oracle is not. Oracle's gone, like, they're profitable, but their cash flow has gone negative. So they're spending now more in terms of capex than what they've than what they're getting in. They're also going deeper into debt to do this. And as I said, like, they're not a lot of the stuff they're doing, they don't own the land and the data centers itself. That's a partnership with others. Often it's not always the case, but often it is. And so they are sort of in this weird position where they're like, I'm getting somebody to do this part of it, I'm getting somebody to do that part of it. I'm grabbing this middle part and trying to grab as much of the profits and everything like that that I can from that part. So again, it's that because of the quality, that's that quality element once again is showing up. Is that, okay, this is starting to get more risky. And in being more risky, yeah, there's more downside, but there's also more upside in that you're getting something that's got a lot of, reasonable amount of debt and other things, because, this company's sitting there with a reasonable amount of debt and growing its debt. And so when you look at the total value of the company, you're like, okay, the total value of the company is whatever, $1.5 trillion, of which says 600 billion of debt and $900 million of equity. And you go, okay, if that's the whole thing's 1.5. Now, if you can move it to, let's say you can double the size of that in terms of value. Well, because there's so much debt in it, well, the debt doesn't change when you double it. So it goes from 1.5 to 3, and so now your equity goes from 900 to 2. Your total value of the company doubles, but your equity side might go from 900 to 2.4 trillion. So it's actually gone way more than double. So there's leverage within it as well. And so again, it just makes that, it's a very interesting take on it. And I've got a few more thoughts around this whole risk part, but I might just jump to one more quick message before I get to those.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Actually, before I get into the next stage, let me just had a few questions come through, so I'll just answer a few of those. So just thoughts from Danny. Magnificent 9. You need to include Broadcom. That is that's a reasonable thought as well. Broadcom's certainly picking up a lot of profits as well. They're one. The way I sort of look at a lot of the. I'm going to exclude Tesla from this, and I know there's a few Tesla fans out there that I'm just because to me it's not sitting in this. It's not sitting in the same bucket as everyone else, but Broadcom's sort of sitting in the more expensive part of the whole boom side. So you look at Nvidia and Microsoft and Google and AWS and these others that are sort of got these. You've seen reasonable share price increases or massive share price increases, but you've also seen earnings really tick up, and so the multiples they're trading on are not terribly unreasonable. You need to assume the growth is going to continue, or a reasonable amount of that growth is going to continue for at least a few years, but it's not. Then they're certainly not at hugely high levels. Broadcom sort of sits at the stage where it's starting to get up there in terms of the pricing of it. So you really have to get a lot of growth to sort of justify the prices for Broadcom. May well get there, but it's certainly got a lot of that priced in. Whereas I sort of feel there's a little bit more safety in some of these others. I think if you look at Oracle, it's in the Broadcom category or worse. I mean, I do still need to see where these numbers come out. It's only just been announced. We'll have to see where the sort of consensus forecasts come back in terms of what the earnings are before sort of talking too much about the valuations, because there's really big revenue increases, but as I said, these guys they're not. Oracle's not that much in control of a bunch of things within it. So it's sort of basically selling a product to somebody in terms of saying, okay, whatever, Ford, I'm going to do all this AI processing for you for whatever you're doing within it, or OpenAI, I'm going to do all this processing for you. I've got orders in and to buy all the chips from Nvidia, and I've got a deal with somebody to set up a data center, and I've ordered my power from I've got some contracts for all this power and stuff like that. But it's not like they're getting the whole amount themselves, and there's demand on everyone in the supply chain. Nvidia is a great example of people. There's demand for everyone's products. So Oracle's going to get the revenue, or sorry, they look like they're going to get the revenue. It isn't that certain as to what the margin's going to be and where they get squeezed and where they don't. But and so that's sort of Oracle. I'm going to reserve judgment, I think, in terms of pricing for the moment. It does look very expensive on where it is today versus where we had earnings at yesterday. But based on our numbers, it's going to end up in the 40-ish to 50th range probably. But I really do need to sit down and look through some of these margins in a lot more detail, because I think there's. And even then, sorry, I'm looking through the margins in detail and what people are forecasting. But there's so much uncertainty in it because, it's just very hard to tell what any of this is going to be priced at, and these guys aren't in control a lot of the price chain themselves. So there's that part. A few questions about ASX companies that you can invest in, so you don't have to worry about setup and all that sort of stuff like that. Look, not really. If you are, there probably will be some smaller ones that'll be an equipment supply to somebody that all of a sudden needs 10 times more equipment than what they used to have, and so you'll see prices shoot up. But there's not any Australian companies that are really in charge of their own destiny in this space. I would be I'd say cough up and take the exposure. So we do have various exposures you can get to in terms of AI exposure and stuff like that by taking some of our tilts. But we effectively run for a lot of this. We run accounts for people and across different platforms. But one of the platforms is Interactive Brokers that we sort of suggest that's where effectively what we have for people is. You say to us, okay, I want to buy international stocks and give me a little bit of extra AI and give me some extra cybersecurity and take out carbon, anything to do with climate change. We go, okay, there's your portfolio, and there might be 100 stocks in that for you, and we're buying all the fractional shares and managing the currency and all that type of stuff like that for you. What you can do though is you can then we can just set up a side account for you. You can do whatever you want on that side account. And Interactive Brokers is certainly. There's some questions in the chat just about stake and some of these other ones. The real benefit I see from us looking at and the ones we look at is Interactive Brokers. What they do on the currency is really, really good. They charge you they charge you effectively the mid rate of currency, so the actual trading rate you can get, and then they have a fixed fee on top of it, which is like a few bucks that they'll charge on top of that. Whereas what you see amongst almost all the or most of the stockbroking community is they'll talk about how low their fees are, and then they'd absolutely screw you on the currency. So it's basically saying, well, yeah, I'm charging you nothing on trading, but I'm charging you 2% on the currency translation or something like that. There's some crazy numbers that they're charging on that. So the main thing, if you're going to invest in US stocks, have a look at the conversion rates that they're using, and the one we suggest as well. We'd love you to come to us, but if you're not, then pick somebody like Interactive Brokers that gives you a very clear and currency, because that's the secret sauce in a whole bunch of these. Even all these big, I don't want to say even the big ones. Like if you look at Commonwealths and NAB traders and things like that, it's like when you've got your credit card and you're out there and you buy something in US dollars on your credit card, and you find that they've charged you 2 or 3% on the conversion, and that's the way they'll treat a lot of the trading stuff as well. Anyway, so that was that one. The other thing I did want to talk about was just these analogies to the tech boom, and the main thing on the analogies to the tech boom that I wanted to highlight was, within the tech boom there was a certain amount of self-perpetuating growth that you got, and what I mean by that is, you'd see companies raise money, and ridiculous amounts of money. They'd be like, yeah, I'm just, I'm pets.com, or whatever it is, something.com, just stick a .com behind your name, and I want $100 million, or I want $1 billion, and we're going to, whatever we're going to do. We're going to do something on the internet. Give us some money and off we go. And they were very, and they would, people would give all this money out and the capital raise, and the stock would go up. And what would the stock do is, well, then it would go out and buy advertising with all these other people, and effectively what you're doing was raising money in the stock market in order to plow it into these other companies. And so that was sort of this self-perpetuating, oh, look how much our profits have grown because there's all these other companies out there raising capital from people and pouring it in, and so therefore our profits go up, which is great until it goes into reverse, and it stops. It's like, okay, no, capital raising have stopped, people have run out of money to stick into this. And then you start going to reverse, because it's like, well, now my profits are down. Everyone's bought me and are expecting me to go to the moon, but now my profits are down because there's no more companies raising capital, giving me money to go out and do whatever I'm doing, and so the whole process went into reverse. And so that's one of the things you need to be like, whenever we're looking at booms, we're trying to work out where the money is coming from, and so when the tech boom, that was red flashing lights all the way up, was that this money's just being recycled. You get into some of these housing booms where it's all debt driven, and you're just like, okay, yes, house prices are up, but they're only up because people are willing to take on more debt, and so you can look and go, okay, well, how big can that debt grow, and there's certain limits to that. So when we start seeing that within the AI boom, that's where I'm going to start getting concerned, is that we start seeing companies going into debt, companies raising money to then go and invest it in and go stick it in and give it to Microsofts and Googles and stuff like that. So that is happening at the margin. So let's take OpenAI, for example. They're out there raising money in order to go and spend it with Oracle and spend it with other people. So is that sustainable in the long term? No, it's not. The guys need to genuinely make some money from that. But that's not the core part of the that's a relatively core part of this growth we've seen in Oracle, but it's not real. It hasn't to date been a core part of what we've been seeing in Microsoft and Google and AWS. So it hasn't really been this self-perpetuating, people are raising money in order to give it to us to then go and build stuff for them. It's been more about companies, so genuine companies out there wanting to spend more money on this and making sure they're not going to end up, as a dinosaur in the system. It's governments out there wanting to go, well, we need to spend truckloads of money because we're worried the Chinese are developing drones or the Russians are developing drones, and we want to make sure that our drones can beat their drones, and we need AI to do all this other stuff. Like, there is genuine money out there that is being spent by individuals and companies and people in the sort of real economy to do this. And so, so from that part, I've been less concerned. But this Oracle one is starting to get down the path where you're like, okay, you're getting this big deal, $300 billion from somebody who's raising money in order to, and their profits are, they're losing money. OpenAI is losing money, and they're sort of doing sales of tens of billions of dollars rather than hundreds of billions of dollars. Like they're not, you know, OpenAI is not a company you would look at and you would say, based on your sales profile, yeah, sure, I'm happy to loan you $300 billion in order to buy data centers. That's not or processing power. It's not the type of thing you'd look at. But you can go, well, as long as they keep growing and all this other stuff happens, they keep raising capital, then that's fine. They'll meet their obligations. But it is starting to get to that point in terms of, at least it's not. I don't think the warning bells will ring loudly, but it's at least something to start paying attention to now. Is that, are we getting to the stage where it's people raising money or raising debt in order to go out and spend the money on buying NVIDIA chips and doing all this other stuff? And Oracle itself, it's sort of like it's a little bit of a Russian doll in terms of that. Oracle's, it's got these big sales coming from this company that's OpenAI that's raising money to do it. But then Oracle itself is out there borrowing money in order to build the data centers, in order to sell so there's a debt element to this and a capital raising point. Again, they're the smaller player. It's not the basis of the entire industry, so sort of less concerns, but it's at least something that should be aware of and pay attention to in terms of that. Look, so that's all I really had on this. Are we buying or selling Oracle? I think I'm going to keep that to myself for a little bit. We're still considering what we're doing and looking at the numbers. It's a high risk play in terms of versus the others. The others are much cheaper, not as much debt, not going to and cash flow positive and all these other things. Oracle, though, if you believe in the capex boom is going to keep going for another 5 or 10 years, then they are being that bit player, like I was talking about with the mining companies. They're the type, and with lots of debt, they're one of the companies that's going to have the most leverage to it if it goes on for longer. So yes, I'll leave it at that. Hit like and subscribe. We're on Thursdays at 12:30, so definitely throw in throw in some comments in the chat. We had a bunch of them in there today, so yeah, and let us know what you're thinking around this, and hit the like and subscribe button, and I will see everyone next week. Thanks.